My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Complacency? Complacency is a two-way street. We always hear how the bulls are being complacent and ignoring downside risk. But we almost never hear the bears are being complacent and missing out on terrific opportunities, which I find to be absurd. Nobody does complacency like the bears, do they? We see this conundrum play out so often, including today, where the Dow advanced 126 points, S&P gained 0.97%, and the Nasdaq followed 1.45%. Remember, last night, I spent a lot of time talking about how we got a slew of downgrades yesterday that I didn't like, a slew after stocks that reacted to negative news already. To me, they seem like gratuitous notes that would end up costing you money if you listen to them. Why? Because in the last decade, the toughest thing to do is to hold on to good stocks. But analysts and commentators love to take aim at long-term winners. Their jeremiads have scared so many people out of some amazing gains that it seems downright wrong to me. Plus, even if you wanted to take action on these downgrades, you should wait for a bounce at least before you do any selling. Sell. And if it's a downgrade based on valuation, you need to be ready to buy the stock back at a lower level, which is incredibly hard to do even for the best of traders. But the complacency of the bears allows them to keep mauling these stocks even when they're already down, often with the phony nod to the macro, the big picture state of the economy that's really designed to freak people out. Consider what happened yesterday. I was loath to even comment on the downgrades of Apple and Amazon, but I felt I had to because this isn't the first time I've had to strap myself to the mast and hang on for dear life when I heard the tenor of these downgrades. Real scary. If you recall, the analyst who downgraded Apple yesterday was talking about no green light to buy a new iPhone until 2026 to 2027 because of hardware flaws. The Amazon downgrade was concerned about consumer spending headwinds. This right before Amazon's big Prime Deal Days event, where the bargains are possibly mind-numbing. You see the Apple deals? You should check them out. They're really amazing. Now, I told members of the CNBC Investing Club that you needed to either stand pat or actually buy. That's right, buy the downgrades. Because both Amazon and Apple had come down hard from the recent highs before the downgrades. I really like buying some stocks after a 5 to 8% pullback because, well, it's one instance where you get rebounds, and two, you're certainly not top ticking. Let's consider the trajectory here. Amazon reported a quarter that was widely disliked almost 3 months ago. The stock was trading at 184 when the quarter was reported. It then quickly plummeted to 161. But then it pirouetted all the way back to 195 a little more than 2 weeks ago, above. That's right, above the so-called bad quarter, like it never happened. It then goes down almost 9 straight points, which is where it then catches the downgrade. The long-standing issue with Amazon is that you can't get in and get out. A pullback like yesterday, I found it was like a godsend. Yesterday's downgrade gave you a second great buying opportunity since that quarter. Sure enough, today, with no upgrades or downgrades, what happens? Well, the stock bounces and you're free to sell at a better price if that's what you really want. Same deal with Apple. Here's a stock that was at 226 at the end of last week. Lots of negativity built in about how the iPhone 16 is already a bust. Yesterday's downgrade pulverized the stock, sending it down to 221. Today, without an analyst call, it gained $4 and it's right back to 225. If you want out of Apple, this would be the day to do it, not yesterday. Unfortunately, if you were trying to get out and get back in at a lower level, it's already too late. Now, I'm not saying that Apple stock can't go back down again. Just the opposite. It can. I am saying that this getting in and getting out and getting in and getting out stuff is fraud, filled with tax considerations, frictions, and is not for you to do at home. Still, these were big impact downgrades. They drove the stocks down heavily. They, in the parlance of Wall Street, worked. They made people take action. Man, oh man, am I ever sick of people taking action. And then the action's being publicized. Today we got a downgrade of Microsoft saying that Wall Street's overestimating AI revenues. Oh, are we? A month ago, that would have been a timely call. Problem is Microsoft stock had just sunk from 441 to 410, almost in a straight line. So the analyst is coming in after a gigantic decline. So how the stock do with a downgrade? What happened? How low did it go? Did it have the same impact as Amazon and Apple downgrades from yesterday? Hardly. Microsoft stock actually went up. It rallied more than $5 today. I say, wowza.
House of pleasure.
Let me tell you what happens if you're at a research firm and you cover Microsoft after today's big gain. Well, you've been huddled in your bunker. You've been frightened. You've been worried about the macro, petrified of the stock sinking lower a bit every single day. Drip, 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 drip. You're thinking of making the call to downgrade the stock because the pain's too great. You got to get rid of the pain. You got to get rid of the anvil in your back. But then this other analyst from OPCO beat you to it. Once you see, though, that the downgrade didn't work, though, that's when you realize the damage has already been done. And the bad news is in the stock. Mark my words, somebody's going to come out swinging tomorrow and recommend the stock. Hey, you know what? Maybe many people, they just got the all clear side. Now, to me, all this is very silly. You don't want to wait 30 points from the top to downgrade Microsoft. But the stock does feel a bit immunized after that downgrade, doesn't it? Oh, it's not just tech. Anyone who watched the stock of PepsiCo these last few weeks know it's been a terrible performer. 179 last month, down to 167. And actually traded 165, where it traded at 6 a.m. when they reported the numbers. It was a so-called weaker than expected quarter. So the question is, was it really weaker than expected? I don't think so. In fact, given how analysts spend day after day saying it's going to be a miserable quarter, I thought when I saw the results, they weren't all that bad. Plus, the latter part of the quarter was actually better once PepsiCo started spending more aggressively. Hey, Frito-Lay was making a comeback intra-quarter. The company's sticking by its 8% earnings growth rate forecast, which I think happens to be pretty darn good for a food company. No wonder it ended up finishing up an astounding 3.21%. I found that 3.21 cents. Remarkable. This stock, okay, get this. The stock was at 65. I'm going to get this right. It was at 65 when I first saw the numbers. I couldn't believe. I said, wow, those numbers are pretty good. And then it zoomed 5 straight points. That is a remarkable comeback. Just remarkable. I think the people who sold the stock at 165 and closed out at 170 and 42, I think they need to rethink their MO, or maybe they should quit their day jobs. All right, how about Honeywell? Now, I've been critical of the company, wondering when CEO Vimal Kapur was planning to unlock value. I was waiting. Today he makes the move to break up a key portion of the business, spinning off Honeywell's chemical business to its shareholders in a move that's reminiscent of how Danaher has repeatedly broken off pieces of itself. It's a welcome new unlocking of value. Yet the market pretty much yawned. Stock rallied less than 2%. At one point, the stock was barely up at all. It's being totally ignored. That is insane. Now, here you have an eagerly awaited spinoff that makes the rest of the company much more focused. 3 divisions: automation, aerospace, energy transition, all very large teams with a now faster growth rate. It is truly terrific news. Honeywell's a large position for my travel trust, and I've been pushing for this gigantic positive change all along. Yet what happens? The stock does almost nothing all morning. At one point, it's almost unchanged. Finishes up $3.67. I thought this should send the stock up at least $5. Talk about complacency. How can people not care more? Oh, you know what? We actually do know the reasons, don't we? First, we've been gripped by how poorly bonds have been trading. Long rates have been going higher for many sessions. Second, we're waiting for the other shoe to drop in the oil market. But here's what I have to say. What the heck does that have anything to do with the greatness of Honeywell spinning off a division that will make it into a leaner, more focused, better-run company with a higher price earnings multiple? I'll tell you, it means nothing to the Honeywell story. However, on Wall Street, lousy timing is everything. Here's the bottom line. I need you to understand that when analysts downgrade after stocks have already been hammered, when really good investors ignore the positives, then it may be a grim time. But not so grim that we can't make money by focusing on the fundamentals of the companies and not just the economy, the Fed, interest rates, and oil. Let's go to Jim in New Jersey. Jim.
Hey, Jim. A pleasure to speak with you.
Right back
I owe you big time. You're the top of the class. Thank you.
Thank you, Jim. Wow. Thank you very much. I wish my wife were here. I could tell her you feel that way.
Yeah, well, I'm sure she knows. Yeah. So, Plantier was, brought to my attention in February.
Yeah.
I bought it, and then, of course, I sold it.
Oh, why?
Well, so then I wanted to buy it back on a dip.
Okay.
And when is that going to happen? So I bought it at 35, and then yesterday it dropped.
Right. Well, okay. Look, here's the way I feel about Palantir. It's a cold stock. Journals called it that. I didn't have to do that, but here's what you know. This is owned by individuals. They love it. They walk it up. Every time it gets hit, they're buyers. These things happen periodically. It happens to be a good company. I wouldn't buy it up here, but the cult buyers can't get enough, and they take it higher seemingly every day. Stay long and see what happens. This is Becto. Tim in Georgia. Tim.
Jim, love your show. Been watching for many years.
Thank you, Tim. Thank you very much.
Calling about Carnival Cruise Lines. Lately I've been watching it. Things have been looking pretty good. Great bookings, good revenues, earnings, even a reasonable PE today. Yet the company still has high debt. There's a lot of world unrest. And then we now have Milton. Looks like it's going to cut across Florida and potentially be online to hit 2 of their departure terminals. So what's your take?
Well, look, I don't know about the actual weather forecast and where things are going to go. I do know that I do prefer Royal Caribbean. I think it's got better balance sheets, got more momentum, but Carnival's good. I would not look. These cruise stocks are really terrific. They're all good, but Royal Caribbean is my favorite. I also like Viking. All right, listen. When analysts downgrade after stocks have already been hammered, sell. It may look grim, but it's never so grim that we still can't make money by focusing on the fundamentals of the companies. Well, man, buddy, tonight, with Hurricane Milton here in Florida, I'm talking to Generac to hear how the power generator company is helping millions prepare for the second major storm to hit the Gulf Coast in less than 2 weeks. Then, should you turn some focus to the financials? I'm revealing 3 banks that are earning a spot on my Yeld list of strong S&P 500 stocks. Plus, aerospace player Standard Aero made its market debut last week. I'm eyeing its place in the industry and how you should view its initial takeoff to the tape, and you do not want to miss it, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Whenever we have a horrific hurricane season, and this one's only getting worse, I like to check in with Generac. That's the #1 maker of home backup power generators with a big business making batteries for renewable energy. This stock's been on fire lately because people buy backup generators when they're worried about a hurricane knocking out their power, possibly for weeks on end. Generators provide a valuable service here. It's not their fault that the stock tends to go up when bad things happen. These storms are devastating, though. So let's take a closer look with Aaron Jagdfeld. He's the chairman, president, and CEO of Generac to learn more. Mr. Jagdfeld, welcome back to Mad Money.
Thanks, Jim. Thanks for having me.
See, Aaron, I've got to tell you, these storms in particular are kind of, they're mesmerizing the country because it seems like, one, they're more powerful, but two, they're going places that we didn't think that you could have these kinds of hurricanes. Now, for Generac, are you seeing areas that, frankly, don't have a lot of Generacs that probably now people realize, wow, I guess we need this? It's not just the Northeast and Michigan?
Yeah, I mean, you're right, Jim. I mean, the storms have been, first of all, it's just devastating to see the images and understand the damage that these recent storms have caused. I mean, specifically Helene in the Carolinas, and there's a good example where, we've sold some product in the Carolinas over the years, but we're definitely going to sell a lot more given, the type of infrastructure loss that happened there, and frankly the fact that I think people have become a lot more aware that outages can have a lasting impact in a community like that.
Now, what are you talking with people about climate change? Climate change became political in this country. But I feel like when I look at the weather pattern of Milton, when I see what happened in Asheville, I say to myself, let's just get rid of the politics. Something's wrong here. Something is changing the way storms occur, something that will be beneficial for Generac, but obviously not for our country, but definitely for you.
Yeah, I mean, I think the science is clear, right? I mean, the air temperatures are warming, the water temperatures are warming, and we can debate what caused it. But I think the reality of it is the outcome is more extreme weather. So you've got it's 113 days this year in Phoenix over 100 degrees. You've got storms like Milton that are rapidly intensifying inside of 24 hours to Cat 5 strength. You have, these powerful storms that are hitting places that, as you mentioned before, just haven't been hit before. So, I mean, it's something we've got to be mindful of. And, most outages are caused by weather. And so as Mother Nature continues to create these extremities, it's going to create a ton of pressure on the grid.
Okay, so let's talk about the grid, because you also have another division besides residential. You have construction, you have industrial, basically you have a pastiche of many different kinds. I do not want to just pay you as residential. But talk to me about data centers. Talk to me about the problem with the grid. Talk to me about what you're doing to help.
Yeah, it's a great call out, Jim. I mean, 40% of our business does rely on commercial and industrial type products that end up going into, backup for manufacturing plants, distribution centers, hospitals, data centers, things like that. And again, these trends, right? The trends of power quality, right? I mean, I think that's when you kind of wrap around the whole discussion here over the last 20 years. It's very clear. Through the first 9 months of this year, 1.2 billion hours lost to outages in the U.S. 1.2 billion. I mean, wrap your head around that. And so that's not only impacting homeowners, but of course that's impacting businesses as well and other institutions. So, having a backup plan, whatever that plan is, if it's a generator, and that's become a very popular plan for a lot of businesses, it's something that companies have to think about, because they have to think about the continuity of their operations, their continuity of their revenue streams, right? The protection of any kind of inventory they may have. This has become a massive critical discussion point, and this is only going to get worse. The grid continues to be under pressure. We've got on the one side, on the supply side, we're decarbonizing, which is great. We're adding more solar, we're adding more wind, but those are not 24/7 type of generating assets, right? So they're intermittent by their nature. And then on the demand side, what we've got is an increase in demand through the electrification trends that we see, including transportation, right? We're just in the early innings of EV adoption, and now you mentioned it, AI. AI is bringing a wave of data center growth, and that's going to put tremendous pressure on the grid as we go forward.
All right, now let's talk about the all-in cost to get a Generac. You have installation of the actual Generac. They can run into a larger amount of money. Interest rates coming down must also help your business tremendously.
It does, and you have to think of this as a home improvement type of project, right? So it's $12,000 to $15,000 with installation. And that you're right. It's a tidy sum of money. It's not inexpensive, but the peace of mind that it brings is priceless. And so for homeowners who buy this product, it's fully automatic. It runs off the home's natural gas or propane supply, and it's the kind of thing that can really keep, especially as people are working more from home. You're starting to talk about not just the inconvenience of an outage, right? That you might have to be in the dark for a few hours, or some of the dangers that causes, but also the interruption of your livelihood. So as we work towards more of a hybrid work type of environment, this has really become the kind of product or the kind of appliance that homeowners are looking for.
And I was thinking, if I go into people's refrigerator these days, it's not just going to have juice and milk and some other perishables. A lot of medicines. We saw that from COVID. A lot of medicines have to be stored. How can you justify not having a Generac if your refrigerator goes off and your medicines spoil?
Well, this is another use case for the product, Jim. More and more medications need to be refrigerated, right? Even the GLP-1 drugs that have become so popular, those all have to be refrigerated. A lot of diabetes medications, a lot of these other, some people even have home oxygenation machines. They have home dialysis is becoming a trend that we're also seeing. So you have medical devices, you've got medications, as you pointed out. Again, this is becoming a bigger part of the need for an uninterrupted power supply in your home, and you've got to have that backup plan.
Are you surprised that we're actually opening up a unit at 3 Mile Island and talking about recommissioning utilities that were supposed to be, when we talk about decommission, the idea was they were never supposed to be open again. Are you shocked that that's how much power we need?
I think it speaks to the critical nature of the situation we're in, right? I mean, the fact that we would be reopening power plants, and a nuclear plant called 3 Mile Island. I mean, I think I would have started probably with a marketing pitch of changing the name, but let's call it what it is. I mean, there is a significant concern over availability, power availability, to actually have to reopen these nuke plants or keep plants that should be end of life and keep them running much longer than they were intended in their design life. That's what we're up against. And I think utilities and grid operators, they see it for what it is. It's very challenging today to go out there and try and solve their problems the same way they would have solved them historically, right? If you knew there was load growth coming, and this is the first time in a couple of decades that utilities are seeing load growth in the current lifetime, now they would have solved that by putting in a peaker plant, a gas peaker plant, or another type of asset, a thermal asset. They can't do that today because of their decarbonization goals. They really have to look for something, a different solution. And nuclear is an option, but it takes a long time to build a nuke plant. And the fact that we're recommissioning a plant that's been decommissioned says a lot about the state of the grid today.
All right, now, one last question. I know that when we were out in Dearborn looking at Ford, they had the F-150, and they were talking about how proudly, look, if there's an outage, you can just plug your truck into your house. But EV sales have kind of petered out. I mean, was that something you were concerned about for your numbers, and now it looks like that it's not as much of a competition as you thought?
Yeah, I think, the idea of taking, a vehicle, an electric vehicle, and using it to back up your home, I think that's an interesting idea, right? You have this large battery pack sitting in your garage if you already own one. And so why wouldn't you use that? The reality of it is you're really making a trade-off between reliability and mobility, right? So if you think about that situation, if you're out in Northern California and PG&E is sending you a notification telling you they're going to do a power safety shutoff because there's wildfire danger in the area. So your power goes out, you think, okay, I've got my F-150 electric EF-150 in the driveway, I'm good to go. But the reality of it is, after the first day, maybe now you're down to half of a charge. And when does that thought start to cross your mind that, what if there really is a fire that happens and I need to leave? So how long do you use that F-150 or you use that EV before you finally say, look, I need to prioritize mobility over resiliency?
Wow, that's a great answer. Thank you for that. I'd not thought of that. Aaron, you're so thoughtful. I really love it when you come on Mad Money. That's Aaron Jagdfeld. He's the CEO of Generac. Thank you so much, sir. Good to see you.
Thanks, Jim.
Mad Money's back after the break.
Coming up, foray into the financials. Which banks fit Cramer's 3 key criteria? Keep it here.
We're in a very tricky moment right now. Even though the Fed is our friend, making it much easier to own a huge chunk of the market, the averages have also had a monster run. And when you look back at the history, well, October's really been a good month, hasn't it? That's why you need to be selective about what you buy here. It's why all week I'm rolling out my new favorite rubric. We want YEV. YEV stocks that have high yields, that's the Y, strong earnings growth, E, and good value, V. Specifically, we're looking for names that yield more than the benchmark 10-year Treasury, currently at 4.02%. With higher earnings growth than Wall Street expects the S&P 500 to have next year, which is 14%, and a lower price-to-earnings multiple than the overall index, meaning less than 21 times next year's earnings estimates, which, by the way, is historically high. Out of 500 stocks in the S&P 500, there are only 9 stocks that make that YEV list. Last night, I highlighted 2 chemical companies with the highest yields in the YEV list, and that's LyondellBasell and Dow. But you know what group had the most representation here? It was the banks, the financials. There are 3 different regional banks that passed the test, KeyCorp and Huntington Bankshares, both of which are based in Ohio. I talk about Huntington a lot, you know that. And Citizens Financial, that's headquartered in Providence, Rhode Island. I like the regional banks here for roughly the same reason that I like the commodity chemical plays. These stocks have been out of favor for a very long time, but they should do much better in a falling interest rate environment. Of course, some of the regionals are a lot better than the others. We don't want exposure to the outfits that still haven't recovered from last year's mini banking crisis. But KeyCorp, Huntington, and Citizens Financial are all good operators, with stocks that have nearly worked their way back to where they were trading before the Silicon Valley Bank collapse in the spring of last year and really just rained holy heck on all of these regionals. And I think we are now headed in the right direction. The regional banks got squashed when the Fed rapidly raised interest rates, then decided to leave short rates higher for longer. But now that the Fed's in rate cut mode, right, and we know that's going to happen, they stand to benefit, even if the pace of the cut slows down. In fact, we're in a terrific scenario for these guys. The economy's still pretty darn strong to the point where calling it a soft landing feels too negative. Throw in falling interest rates and that's nirvana for the regional banks, and obviously the credit losses will be less if we are in a cut cycle portion. So let me walk you through these 3 regionals that made the YEV list one by one. First is KeyCorp. This is a Cleveland-based parent of KeyBank. It's a high-quality consumer and commercial bank franchise with a sneakily large reach. They've got roughly 1,000 branches in across 15 states, Midwest, Northeast, Northwest. Unfortunately, KeyCorp made some mistakes with its bond portfolio that severely damaged its earnings power when bond yields soared and bond prices got clobbered. Now that the Fed is our friend, that won't be a problem anymore. Plus, a couple of months ago, we learned that Bank of Nova Scotia, also known as Scotiabank, will be paying $2.8 billion to take a nearly 15% stake in KeyCorp. Oh, man, it's a complex transaction, which will take place in 3 tranches. The first tranche has happened, and the other 2 will come over time after the deal gets regulatory approval. But what matters is Scotiabank investment gives KeyCorp a much better capital cushion that it can use to reposition its investment portfolio. I think this is a nice reset opportunity for KeyCorp, and I'd be buying it right along the side of the Canadians, especially since the stock currently yields nearly 5%. fact, with KeyCorp trading at $16 and change, you're actually getting a slightly better price than the $17.17 per share that Scotiabank's paying for its stake. Hey, that sounds good to me. Next up, the Columbus-based Huntington Bank shares. HBAN, the parent company of Huntington Banking, and a company, by the way, we know well after speaking with CEO Stephen Sinauer several times over the last couple of years. I recommended this one in early August, and when the whole market sold off hard after the yen carry trade fell apart, remember that fiasco? Since then, it's rallied nearly 11%. I felt comfortable recommending Huntington into weakness because we just had Steinauer on the show less than a week before in the wake of a very healthy quarter. Steinauer told a real positive story, saying that we're on the verge of a rate-cutting cycle, and after many banks spent last year on risk-weighted assets diets as they recovered from the crisis, that's mostly over now. Listen to this.
We are incredibly well positioned in the Midwest. And in addition, we've recently expanded in the Carolinas and a bit into Texas. So we have this unique franchise with a lot of growth potential. Columbus itself, our headquarters city, is doing phenomenally well. We've been growing deposits every quarter. We've grown loans. And we're in a great position to continue to grow and frankly, to help the economy and our customers.
Again, terrific story. Even though Huntington's had a nice run since then, still got a 4.2% yield, plenty of earnings growth on the horizon as interest rates come down. Finally, there's one I don't talk about this one. It's called it's Northeast Bank. It's called Citizens Financial Group. I haven't focused on it since it was spun off by Royal Bank of Scotland a decade ago. When you take a closer look at Citizens, it's got some of the best capital ratios of large regional banks. That matters for a couple of reasons. First, it offers safety. This is how you know Citizens won't be the next First Republic if we have another banking blow-up. But more importantly, in calmer times, it gives them flexibility to do other shareholder-friendly things, dividends, buybacks. In fact, in late July, after hearing all the regional banks report second quarter earnings, analysts at Deutsche Bank called Citizens Financial their top pick in the sector, citing strong earnings growth potential as net interest margins normalize, growth initiatives pay off like the private bank build-out, and their expansion in New York City. And mortgage demand bounced back thanks to lower rates. The Deutsche Bank analysts also know that Citizens has been held back in recent quarters by some significant one-off items, but management is signaling that there shouldn't be much more of an impact from that kind of thing going forward. That all sounds real good to me. So count me in as a believer in Citizens Financial and a believer in the baseball team that plays at the bank. That's the shorthand name for the Citizens Bank Park, home of the Philadelphia Phillies. Here's the bottom line. In a market like this one, you do need to be selective, which is why we've fallen back on yield, on earnings, and on growth, and on value. Okay, now these are all things that are very hard to find right now. Now you can find it in some of the best regional banks, KeyCorp, Huntington, Citizens Financial. Keep waiting. We have got more. We have more YEV names. Don't forget, yesterday's were Dow and LyondellBasell. These are all really good situations that you ought to consider if you're thinking, well, have I missed a lot? You haven't missed these. Let's go to Nathan in Oregon. Nathan.
Hey, Jim. How are you?
I am good, Nathan. How are you doing?
Good. Long-time listener and member of the Investing Club.
Oh,
so
thank you, buddy. Thank you. Thank you very much.
I'm also a long-time holder of the stock Lending Tree, ticker symbol TREE. With the interest rates going down, should I continue to hold the stock?
Yeah, you can continue to own it. Doug Lebner's really kind of done a really good job there. He's not a kind of an untold story, and it's a very good one. I've known them for many, many years, and he's doing quite well. I think you're in good shape with that one in the future earnings. This current has not been that good, but I think going forward it's going to be better. Let's go to Alan in Florida. Alan.
Hello, Mr. Cramer. How are you doing?
I am doing well, Alan. How about you?
Waiting for Hurricane Milton to hit our shores here in Florida.
Oh, I hope it goes okay for you. I'm sorry that you're in the path of that. I really hope it goes okay. It's just awful.
Me too. My reason for calling is I'm a little concerned about the near-term prospects of the home builders and the suppliers of all the goods that go into new homes since the time when, 2 weeks ago, the Federal Reserve lowered the interest rate by 0.5%, yet the 30-year mortgage has gone up 0.5%.
Okay. And which stock are you worried about in particular?
Like Builders First Source or Home Depot.
Well, I think the Home Depot, which we know from owned by the Charitable Trust, is really the sweet spot because you also have the remodel and renovate that happens when you have these terrible hurricanes. Builders First Source has some of that, but I agree with you. The stock's up a great deal. I like the company. It sells at 16 times earnings. It's good. But a more pointed way to be involved right here with that mortgage rate backup is indeed with Home Depot. And thank you very much for your confidence. Right now, you can find yield, earnings growth, and value in some of the best regional banks. Key, Huntington, Citizens Fin. These stocks have been out of favor, but I think they'll do much better in a falling rate environment. Much more Mad Money, including my breakdown of industrial IPO Standard Aero. You don't want to hear that. Plus, I'm looking at the latest activist action in the boardroom, including potential CEO shakeup at Pfizer. I'll give you my take, dig deeper into the possible shareholder impact. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Over the past couple of weeks, the IPO market has quietly come roaring back to life. While most of these deals were small, relatively unappealing, there was one major listing last week that really caught my attention. That was a company called Standard Aero. That's SARO for you home gamers. This is a private equity-backed private provider of aerospace engine aftermarket services. They help airlines and the military private jets maintain their engines. And it turned out to be the third largest IPO of the year. This Standard Oil deal was actually remarkable. Even if they upsized the deal from 46.5 million shares to 60 million shares, there was still more demand than supply. Stock was priced at $24, above the high end of the proposed range, then opened at $31 and finished its first day of trading at $32.75. That is a 36.5% gain in a day if you actually got a piece of the offering. And the stock hasn't given back any of those gains. It's now just under $33 and change. This is quite different from what we've seen from the IPO market in a long time. Now, clearly, there's a lot of interest in this one. So is it worth taking a chance on Standard Aero after that tremendous first-day move? Let's start with the basics. Standard Aero is the world's largest independent pure-play provider of aerospace engine aftermarket services. You need your airplane engine fixed, they've got you covered. Crucially, Standard Aero serves as a bridge between engine makers and aircraft operators. They work with every major engine maker and hold long-term licenses and authorizations to provide support for the products. They're the official repairman, which is why Standard Aero holds leadership positions on most of the engine platforms that it works with. In fact, for several engine platforms, they hold contracts directly with the manufacturer, contracts that designate Standard Aero as the primary or even the sole sourced maintenance provider. Over 77% of the company's revenues last year came from long-term contractual agreements. I like that. That's safe. It gives a nice recurring revenue base. This is a highly regulated industry, so it's easy for these guys to fend off the competition. Big moat. Standard Aero also has a smaller engine component repair business that's only 11% of sales, but it carries much higher gross margins. Good growth. Pretty good. Now let's talk numbers. In the first 6 months of 2024, Standard Aero had $2.58 billion in revenue. That's up 12% from the same period last year. In fact, they've had double-digit revenue growth for years now. The earnings front's a little more complicated, though. Standard Aero's had a solid operating income for each of the last 3 years, but the balance sheet, frankly, is not so hot, which means high interest expenses that drag down the earnings per share. The company reported small net losses every year from 2021 to 2023, before managing a very modest profit in the first 6 months of the year. That's good. If you take a more forgiving approach and look at the earnings before interest, taxes, depreciation, amortization, Standard Aero has been putting up some very solid EBITDA growth. From 2021 through 2023, they had 21.5% compound annual EBITDA growth rate. I like that. Basically, the core business here is very good, but the company's been dragged down by the balance sheet. Unfortunately, Standard Aero was a private equity-backed IPO, and nearly all these things have got public loaded ungodly amounts of debt. This company in particular has bounced among multiple private equity owners over the years. Standard Aero's current private equity sponsor, Carlyle, bought the business from the Veritas Capital in 2018. Veritas bought it from a large aviation services and aircraft leasing company called Dubai Aerospace Enterprise, or DAE, in 2015. And back in 2007, DAE actually bought the business from Carlyle. Now, not every private equity-backed IPO is a loser. But when you see the situation, it means you got to take extra care. You got to check out this balance sheet really closely. Fortunately, Standard Aero is using all of its proceeds from the IPO to pay down debt, and that is really good. According to the pro forma financials in the IPO prospectus, Standard Aero's total debt load will decrease from $3.3 billion to $2.13 billion, thanks to the IPO money. Now, so we have to ask, is the $2.13 billion in debt problematic? But if we use a back-of-the-envelope adjusted EBITDA, that was that number I gave you before, EBITDA estimate for 2024 of, say, $646.3 million, which assumes a 15.2 growth rate versus last year, growth rate they put up in the first half. Then Standard Aero would have a leverage ratio, meaning net debt divided by adjusted EBITDA of 3.2. Okay, it's not great, but it's not that worrisome either. So we're not going to just focus on that. So I'm not that worried about the balance sheet anymore, especially when you remember how much money they raised in the IPO. But there's a second issue here. When you're dealing private equity-backed deals, usually the sponsor retains a very large stake in the business. In the case of Standard Aero, Carlyle, and another firm, it's actually Singapore's sovereign wealth fund, will collectively own nearly 80% of the business. That means two things. First, common shareholders are not in control of the situation. Carlyle is, though these days that's unfortunately pretty common. Second, whenever Carlyle and Singapore's sovereign wealth fund decide that they want to sell the remaining stock, they could obliterate the stock, and we have seen that happen again and again. However, given Carlyle's long-term involvement in Standard Aero, I bet they decided to stick around for a while. In short, that huge private equity position is something to worry about long-term. I'm not thinking it's going to cause a problem short-term. Now, let's put it all together. Is Standard Aero worth investing in? I think it's a very good business, and when you drill down on valuation, it's trading at a reasonable price. On an enterprise multiple basis, that's the enterprise value divided by the EBITDA. Standard Aero is a bit cheaper than GE Aerospace or our favorite, Howmet. Granted, those are engine makers, and this is an engine maintenance and repair service. But honestly, Standard Aero has so much recurring revenue, I might argue it deserves a higher multiple than the engine makers, not a lower one. Given that airlines are running near maximum capacity here, I think they need all the maintenance they can get, which means Standard Aero's a buy. Doesn't help that only two companies can build commercial aircraft at scale, and one of them, Boeing, is struggling to make new planes at all. That means the airlines need to get the most mileage out of their old planes, which translates into, yes, more business for a maintenance outfit like Standard Aero. So let me give you the bottom line on this one. Even after Standard Aero's hot start, and it is hot, the valuation looks reasonable to me, especially in the context of a market that can't get enough aerospace exposure. I think you've got a good one here. And because of the scarcity factor of quality aerospace companies that are publicly traded, I would be a buyer right here. Mad Money is back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the live encouragement. Right, that's right. Bob calls them. Say bye. Sales will don't know the call. So my step for the blame. And then the lightning round is over. Are you ready, Steve? Time for the lightning round. Encouragement. So with Frank in New Jersey. Frank.
Yeah, Jim. I just wanted to know what your outlook was on Unity software, symbol U.
Why? I mean, because the chart looks a little bit better. It's coming back a little bit. When they start making a lot of money, then give me a call. Let's go to Peter in New York. Peter.
Booyah to the captain of Clay America. Jim, how are you, sir? I want to thank you for the last 35 years of all the help you've given me to where I've been today, along with everybody else.
Well, thank you. Thank you. What's up?
Okay, my stock is Alumis.
Man, that is a really incredibly speculative situation. As long as you know it's speculative and you could lose everything on that one, go ahead. It's not my cup of tea. Let's go to, speaking of that, let's go to Garrett, New York. Garrett.
Hey, Jim, what do you think about Target, PGC?
I don't know. It's still hanging around at 3%. I mean, everyone's at 3% yield. Everyone was worried about it yesterday. Today, these stocks are bouncing back. I'm going to buy some Target at this price and then wait another 5 points and buy more. I like Target right now. I like what Cornell's doing. Let's go to Rose in Pennsylvania. Rose.
Yeah, booyah, Jim.
Booyah, Rose. What's happening? Woo.
All right. I'm a first-time caller, and I've been watching you for years.
Thank you.
My stock is SoundHound AI.
I think SoundHound is a meme stock. It loses money. The only one of these meme cult stocks I actually think is really for real is Palantir right now. I am not going to go and endorse SoundHound. I am sorry. Let's go to Jerry in Pennsylvania. Jerry.
Hey, Jim, how are you?
I'm doing well, Jerry. How about you?
I'm doing well. Hey, the first thing I got to say is, how about them fighting Bills?
Oh, man, I don't know. We got a big game tonight. What's going on?
Big game tonight. Hey, I'm calling about Merck.
Well, look, I think Merck is confounding me. This stock seems to go down almost every single day. This is St. Merck, for heaven's sake. It's a really wonderful company with great management, and I believe in it. And I think at these levels, you want to buy the stock of Merck. Let's go to Tim in New Jersey. Tim.
Tim O'Brien from Cranford. PCT, Pure Cycle Technologies. What do you think?
Cranford Yellow Jackets. We crushed you guys every time we played you. And we never cheated once. I swear. The whole thing was just because we had some 14-year-olds playing with a 12 and under? No, just kidding. Okay, listen to me. Recycle is really kind of interesting. Recycled plastic is a good business. I also like the way, by the way, the spinoff of Honeywell, which is going to be really special materials. That one's going to work very, very even better than this one. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, from the friendly skies to the science lab, which CEOs are on the hot seat? Cramer clocks 2 stocks that may be next in line for a change at the top. When we return.
Accountability is back in style on Wall Street. If you underperform as a CEO these days, you may actually get fired. We saw it at Nike and Starbucks. It's what CEO Bob Jordan at Southwest Airlines seems to have averted for the moment. And it's what the activists seem to be looking for at Pfizer. I think we've all gotten pretty cynical about how CEOs get to hang on despite their stocks doing poorly year after year. We figured that the board is checked out, nothing's going to happen. But that's no longer the case. When Luxman Narasimhan produced some truly subpar results at Starbucks, all we heard was that the board stood by him. Hey, maybe they did. Until they got Brian Niccol, the terrific CEO of Chipotle. And then they fired the old CEO in a heartbeat. It hit us last quarter, and the old CEO's suboptimal response were just too much for the board to take. Nike? There was so much value destruction here so fast that it must have been hard for the board of directors to stop the train wreck. The rank and file, though, they couldn't believe how poorly the company was doing given its pristine reputation. Nike alienated core constituencies, stopped innovating, and treated a trusted partner, Foot Locker, like trash. Memo to ousted CEO John Donahoe: when you're charging hundreds of bucks for Nikes, the customer might want to try them on rather than just ordering directly from the website. As for Southwest Air, it's battling the activists at Elliott Management and just offered what I think is a credible plan to change some of its ways. Sure, the company should have done all this years ago, but they finally got it on the right track. Plus, they have a board member who bought more than $100 million worth of stock in the open market. They're talking about a ring endorsement. Rakesh Gangwal, he's the board member, says he likes management's plan. He's the co-founder of Indigo, India's largest airline by fleet size, so he knows the game. That said, I'm not sure we have heard the last out of Elliott. They usually do get a little more of their way in situations. Now, Starboard Value, another excellent activist firm, has taken down $1 billion worth of Pfizer stock, and they want the board to bring them the head of Dr. Albert Bourla, the CEO. Pfizer stock has indeed done nothing for ages, even as it got billions upon billions of dollars from its COVID windfall, both the vaccines and Paxlovid, the treatment. Starboard believes management has blown. Starboard believes that Pfizer's management has blown way too much money, just on failed acquisitions, underperforming, too expensive acquisitions like the $43 billion purchase of Seagen. I don't know. What's noteworthy about this stake is that Starboard approached Ian Reed, the former CEO of Pfizer, and Frank D'Amelio, the former CFO, and really a fabulous one, by the way. And they both agreed to help the activists because the current underperformance is so severe that they're just upset. I think that's extraordinary. Bourla was their guy. At least I thought he was. They want real change, specifically an end to what they think is a bloated organization, not to mention better monetization of Pfizer's recent acquisitions. Of course, Starboard's $1 billion investment doesn't mean all that much to a $165 billion company. But with Reed and D'Amelio on board, it's serious business and very hard for the board of directors to ignore. Now, it is true that Bourla did misjudge how much money would be coming from the COVID business. But I like the Seagen acquisition, and the company has some novel treatments for hard-to-cure cancers. I thought that was really good. Still, corporate boards are now hearing what the shareholders are saying, and when the stocks are underperforming, they're even getting restless themselves. Look, I think it's about time. Whether it's internal or part of an activist push, it's good news for shareholders that the stewards of shareholder money are finally taking their job seriously. Shareholders need their protection. Is it right to depose Bourla? I think it's too soon because Seagen could turn out to be a huge home run. But if the former CEO and the former CFO are unhappy, then maybe I'm just too darn complacent myself. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.